in terms of the day-to-day stuff, I'm a big fan of what Steve Pettiff says about having 3 months worth of gold, silver, and cash on hand for day-to-day sort of expenses and that sort of thing as well. So I've actually been applying that to my own situation, just building that up slowly, bit by bit, and that's been fun too. So that's just a really practical thing, I think, in terms of the day-to-day stuff.
If there is a collapse that comes, a lot of people get frightened from the stock market and just get scared. But what are you guys actually doing to prepare for the crash in terms of making an income from it? Because there's a lot of quotes that share recessions create opportunity and make more millionaires. So what are you guys actually doing with the stock markets and trading to actually make the crash count?
So it is true, I believe, that there was more millionaires made after the Great Depression than at any other time. But that's often because old companies and old businesses go out of business. And so therefore you end up with people being given the opportunity to go and start their own where they were crowded out of the market before. And you saw that again after 2008, that there was a lot of relatively small businesses that grew relatively big, and were able to capitalize on the growth that happened. So protect your assets. Firstly, if you think that there's a crash coming, I want to be very clear. I'm not a financial advisor. I don't have a financial advisor's license or anything like that. So the things that I'm saying are just my opinion. They're for informational or even entertainment purposes. Don't act on anything that I'm saying. It's just my opinion, my take on things, and I could have a totally different opinion tomorrow. So if you are looking for advice, please go and get that from a suitably licensed professional. That will apply to Derek as well, but I'm sure he'll give you his own disclaimer. Protect your assets in the first place, and then look at those places to invest in after the crash. As far as me, because I'm always in the markets in some way, shape, or form, I'm looking for those companies that I think will be more resilient, and I also look for trading, parts of the economy versus other parts, or certain sectors versus other sectors. So, for example, I might think that the travel and leisure sector will improve by more than the tech sector will, and so I might place a negative bet on the tech sector with a notional value of X, and then have the same notional value of X with a positive bet on, I'm just making this up, on the tourism sector, and then see how that plays. And of course, they both might go down during a crash, but the question is, which one goes down by the most? And so those are the sorts of things that I look for. We know that, for example, that a very tech-heavy NASDAQ index will often lead the S&P 500, which it has been doing for quite a long time. But we're beginning to see a bit of a breakdown in that relationship as we're beginning to see the tech sector suffer disproportionately more than what the S&P 500, which is a much broader index, has, or even the Russell 2000, which is even broader again, has suffered. You can look at certain components within the Dow. One of the trades that I got very, very correct, going back sort of 7-8 years ago now, 6-7 years ago, something like that, was CSL. Now, I really liked CSL at the time. They were about $60 a share. What I liked about them was the Australian economy was looking quite shaky, and the Australian economy was actually beginning to fall. What I really liked about them, that's Commonwealth Serum Laboratories, and then it obviously became, it was privatised and then listed on the market back in the 90s, I think it was, or the early 2000s probably. What I really liked about them is that a lot of their products were sold around the world and in the United States. They had a really big presence in the US, which meant that a lot of their income was in US dollars, and a lot of the economic conditions that would affect them as a company was going to be more affected by the US than they were going to be by Australia, in my opinion at the time, and I'm oversimplifying what I thought at the time. Now, it's actually relatively rare for me to even do that much fundamental analysis, but I liked CSL. And so I got into CSL, and ultimately CSL went from $60 to 200. I'm not sure where they are today. I assume they probably have fallen back from those figures, but they went from $60 to 200. But actually within a space of the first few months that I was in that trade, it went from 60 to 100. Now, because I protected my risk, I was able to leverage that trade a fair bit. So that increase, that 2/3 increase in the price, 60% increase in the price, actually was a really significant return on my capital at risk when I put that trade on. So coming into this next situation, there's always going to be trading opportunities. You just have to look for them. And again, I think that's really paying attention to your risk factors first. If you can pay attention to your risk and know that you're safe and secure in absolute terms, then you can take a few more bets and you're not going to get them all wrong as a general rule. Derek?
I'm always a big fan of what Shaq does with delta neutral trading and that sort of thing. Probably easier to understand calling it non-directional. That's basically when a black swan event happens, you're okay. You think it might go up, goes down, you still possibly make a profit out of that. And for me, that's a very, very cool factor. To me, it's always about the sleep at night factor. So looking at that, in terms of the day-to-day stuff, I'm a big fan of what Steve Penniff says about having 3 months worth of gold, silver and cash on hand for day-to-day sort of expenses and that sort of thing as well. So I've actually been applying that to my own situation, just building that up slowly bit by bit. And that's been fun too. So that's just a really practical thing, I think, in terms of the day-to-day stuff.
Yeah. And for someone who's never actually learned about trading before, I know it's definitely a good thing to look into if you're looking to create an income, especially for a crash, because having income sources which actually survives economic crashes is really important. So for someone new to trading, where's the best place to start with that?
I think it's really important for people. I mean, if you're brand new, it's fair enough to just go and buy a share in companies that you like and know, right? And just hold them for a long time. You can do that. I think it's quite helpful for people to learn a little bit about derivatives and how they work and some of the common strategies they're used. And the reason why I would say that is because almost nobody who does it professionally, as I know them, will just go out and buy one share, right? People will buy a whole series of shares. If they're in a buy-only fund environment, they'll buy a whole heap of different shares. But what they'll do is they'll buy shares in uncorrelated industry sectors in the hope that they get diversification. So for me, I don't really like the idea of diversifying for the idea that it's safer, because what I hear people say is, well, what happens is if part of the market goes down, or if some of your shares go down, that'll be offset by the gains in the shares that went up. Or yeah, but that also means that the shares that went up are going to be, the profits will be offset by those shares that went down. What's the point? Now, I know it's not as simple as that, and over the long term, the share market does have an upward bias because of inflation and other factors. But I think that with derivatives, it opens up a whole world of other trading strategies and other trading ideas. And you don't need to master them all, but just learn a couple and then start to sort of think about how they work and how they interact, and whether or not you can incorporate those into other ideas that you already have. I don't think there's any point in you learning trading if all you want to do is just go and buy 2 or 3 shares in 2 or 3 big Australian companies that you know and hold them for the next 20 years. You don't really need to learn anything, right? Just, you're going to go buy those blue chip companies. I mean, lots of people do that, and most people's superannuation funds are sort of, invested in that kind of way. So if you're talking about starting off in trading, well, then learn actually trading. And trading is more than just the share market. It's also understanding how other types of financial instruments can work.
For me, it's recognizing that stock market is a very different kettle of fish than property. I see too many people try to apply a property strategy to the market. buy low, sell high. And I think Shaq's highlighted the weakness of that. You got to understand it's a totally different kettle of fish. The market can move three directions, only three directions, either up, down, or sideways. And there's different strategies that traders can do to position themselves to profit from that, whether that be, you know, the one we've just described, buy low, sell high. Then they either go directional, they're trying to pick which direction the market may move, whether it be up, down, or sideways. Then you get a third dimension that basically they're looking at time-based strategies, pretty much like your dividends collectors. They're trying to collect that profit every time, but you can actually do that with options. And the fourth is non-directional. I think it's a question of where do you want to be in the game. I always say to anyone who is wanting to really go down that path, though, is understand that it's an apprenticeship. It's not something that I don't sell a get rich quick scheme at all. It's like, you know, if you sign up to be a plumber, you're going to spend a number of years studying it and then actually on the tools doing the work before you're actually a fully fledged qualified plumber. Why is trading any different? I think it's a process where you, as Shaq has highlighted tonight, you begin to understand yourself and your relationship to money and your relationship with the market. You develop strategies that you think, you know, fit your risk aversion, and that's different for everybody. What risk are you comfortable living with, sleeping with at night, and in developing, fine-tuning your craft and going from there. And it's just, I think one of the best lessons my first mentor ever gave me was, he said, Derek, we want to see you build your confidence. That's the biggest thing, getting small, consistent wins over time, as opposed to, you know, just getting big wins all the time and then losing. And he said, you can always lose money. He says, if you lose your confidence, you're in trouble. So for him, it was always building that confidence, the strategy worked. And I think that's one of the things I've seen and noticed with traders is they develop a strategy and then they stick to it. They swear by it. Shaq, in his situation, he's a little bit more diversified as far as strategies are concerned as well. But that's because he trades at a level of industry level as opposed to the retail trader. Your retail traders, it's a different game. It's a different game. It's the difference between high school and university. And that's where the mindset changes again, even going up to that level.
I think it's well worth noting as well that most professional traders, as in traders who trade for a living, don't trade for themselves. They trade for a managed fund, a superannuation fund, a hedge fund, a bank or an insurance company or something like that. So if those guys are working 9 to 5 or whatever for a living, and you're trying to trade and not even use strategies like they're using, but just using basic strategies, you're not going to be likely to outperform them, right? And I think that you know, once you've got enough money behind you, investing in the markets it should be another investment for you. It shouldn't be a complete replacement for your income. Okay, it should be just an addition to it. If you're younger and you want to actually do this for a living, well, that may be a different story. But yeah, I mean, if the people who do it for a living can't give up work to do it for a living, right? Because if they could, they wouldn't be working where they're working, presumably. Then, you know, what makes you think you can? So, and I'm not trying to say that to scare people off. Or what I'm just saying is, you know, be realistic about what you're likely to achieve and what you're going to do. Now, you have some advantages over bank traders, obviously, because you're dealing with smaller amounts and they are smaller to place, which means you've got more opportunities. But there are some opportunities that you don't have. But, you know, again, when you're starting out, pay attention to your risk, learn what you can learn, but try not to get yourself too overwhelmed as well. I think it's a balancing act with all those things.
Yeah, I like that. And like I was saying before, I suggest anyone who's listening to this, if it is something you're wanting to explore in terms of creating, whether it's eventually a full-time income or whether it's a side hustle, like Shaq was saying, just getting it not for a replacement but more for an addition, then I do suggest watch Derek's videos, because I've done this course, helped me understand a lot about the economics and the markets of how finances work. I couldn't recommend it more. So it does give you that basic foundation. Obviously, anyone who wants to take it further and learn it properly, then Derek does share more about his course. And I know there's a few people on here who have done it, but that's just what I'll say, and I've put the link in the chat for those who want to watch it.